Welcome back to Contractor Evolution. It's Igor here, and I'm joined by Benji at our studio.
Hey guys, today is episode 1 of a multi-part series we're going to call the Wealth Builder series. And here's why we're making it. Breakthrough Academy exists for one very simple reason, and that is to transform honest, hardworking contractors into well-balanced leaders and thriving entrepreneurs. And we are super blessed to get to work with over 600 contracting businesses all over North America. And having been at this for 8 years, we're actually starting to get to a point where many of our members are asking us a pretty interesting question. And it sounds something like this. Hey, my business has become a well-oiled machine and it's now making enough money that my family's needs are met. What should I do with the rest?
So to answer this question, over the next couple of months, we're going to be bringing on a number of world-class experts in exciting topics like real estate investments, equities, portfolio management, lending, and the broader world of economics. And the focus is really quite simple, and is how does the entrepreneur behind an efficient and successful blue-collar business become truly wealthy long-term? What should we be doing with our hard-earned profits to maximize our returns, to limit our downside, and most importantly, to design a life that we truly love? So we're going to be releasing a part of this series every other week for the next few months. And in between there, regular Contractor Evolution episodes are still going to be coming up.
Totally. So today's episode 1, we're super lucky to be joined by Darcie Crowe of Crowe Private Wealth at Canaccord Genuity. She's a senior portfolio manager. She's been in the industry for the last 18 years, and she comes at this actually with a background in investment banking and equity capital markets.
So to set up the rest of this series, this first episode is going to be focused on a number of really important topics. We're going to talk about the investor's mindset that you need to have in order to be able to succeed in the long run as an investor. We're going to get into when and why you need to start investing outside of your own operating company. And Darcie's going to give us a really phenomenal overview of what a well-balanced portfolio looks like, how it's structured, and what the various different asset classes within it are. So let's dive in with Darcie Crowe. You're watching Contractor Evolution, where we unpack the systems, tactics, and skills you need to take your fast-growing contracting business to the next level.
You're here to learn what it takes to scale up, work less, and increase profitability. You've come to the right place.
Stay tuned to learn what separates the new breed of contractor from the old school, and welcome to your ultimate guide on the business of contracting. Darcie, thanks for joining us. Welcome to Contractor Evolution.
Thank you. Happy to be here.
I'd like to start with this question, Darcie. This conversation is going to be part of a multi-part series. So I kind of wanted to start with just a really broad question about the conversation we're going to have today, but also the one that's going to extend into the following episodes. And so I want to frame it this way: like, for the entrenched contractor. When I say entrenched, I mean they are in their business, they live it, they breathe it, they're paying themselves what they need, but for the most part, they're reinvesting a ton of their dollars back into the entity, back into the company, with the hopes of growing it to be something great one day, and they will. And so we're not knocking the pursuit of growth, but I do actually want you to just comment on or make the case for why someone really needs to start thinking about putting those hard-earned dollars to work for themselves somewhere outside of their own business.
Mm-hmm. So we can be excellent at building our business and build a fantastic business. But what's really important to be aware of is there is a lot of things that are outside of our control. And those are things, you look geopolitical events that are happening, market events, the economy. A recent example that, of course, is very fresh in people's mind is the pandemic. And unfortunately, these events that are outside of our control can have a very meaningful impact on our business. And we need to be aware of that to properly plan for our future and the financial security for yourself and your family. So that really lends itself to saying, okay, if some things are outside of our control, I don't want to have 100% of my wealth tied to one company or one asset that could be very materially impacted by a market event. So that's the case where we talk about start diversifying and owning different companies in different sectors and industries and businesses on the side of your business to complement that, so that should there be something outside of your control that impacts your business, it is not as detrimental to your overall wealth.
Do you think that you brought up something interesting there? Do you think entrepreneurs overestimate how much control they have over their destiny and maybe underestimate the impacts of some of these events and how they can affect their actual business? Like, is there a comment you can make on the psychology they have towards, that's not going to happen to me. I'm at the helm of this ship. I've got it all under control. Do you think there's maybe some ego there that gets people into trouble sometimes?
Yeah, I'm not sure if it's ego. I mean, you can, if you're a successful entrepreneur, rightfully you feel like you've built a fantastic business, it's growing, it's doing exceptionally well, and that it will be successful in the future. I think it's taking time to step back from just looking at your business and the results of your business and the success of your business, and just realizing that there is a whole world around you that you cannot control.
Right.
And unfortunately, those events can be very meaningful to your business, which is not just the operation of your business. So I think that that's just a reality of our world, the global world that we operate in. And, being naive to that can be very detrimental. I think you really need to have an awareness that there are these items outside of your control, and there is things that you can do to mitigate that.
Yeah, a pattern that I've really noticed with entrepreneurs, and I can speak from this from personal experience, like I've felt this right from literally when I finished university and never had a real job in my life. Like, I've always been an entrepreneur because I've felt the desire, that like deep desire to be able to control my own destiny. I think that most entrepreneurs end up as a business owner because at some level, like, you have that need to control the future. And to what we're talking about here, I think that sometimes you have an overly boosted view of how much control you really have. There's like massive life-changing events that are happening all over the world, maybe as we speak, that we are kind of unaware of, that could have a huge effect on the economics of our business 5 years from now.
Totally.
And having the intellect to realize that, and therefore just make some of these moves that we're about to talk about in this episode and the following ones, I think is quite important. So let me ask you this, Darcie. You work with a lot of successful clients, a number of whom are kind of in their, call it like later stages in their career and their life. People who have done this diligently, like run a successful, strong business, made the right financial moves, the smart moves, had some of this broader understanding and humility to understand, like they're not in control over everything. So they've invested effectively, diversified effectively in their holdings, had good advisors. What does their life situation look like when they are 45, 50, 55 years old?
So they get to a point in their life where really their money, the wealth that they've created over their career, is now working for them. So whether they're choosing to continue to, work or not in their business or elsewhere, their money is now working for them and producing the return and the passive income stream that supports their lifestyle. So that's where they get to. It gives them the freedom. It gives them the financial security. They have that security that them and their family are secure in the future. They're not going to be impacted by, an event happening. So they really get to this place of freedom and control over their finances, and their wealth that they created over time is continuing to work for them, and that provides for their lifestyle. Yeah,
very interesting. Very interesting. So let me ask you this, because this is something that I think is on people's minds often. I know a lot of people there's an inherent human fear around like a lack of resources. I think it's like deeply bred in humans and in all animals for that matter. But something that people, I think about is, what are the big mistakes that I really need to look out for that could severely compromise my future, my family's future, and my success in creating wealth? What have you seen to be the top sort of wealth killing practices that people do where they shouldn't? What would you really advise people to be highly aware of?
Yeah, so there's two things that come to mind. One is, the saying that I think we've all heard is, don't have all of your eggs in one basket. That really can be a very, very detrimental, wealth impairment. Again, that's talking about if all of your wealth is tied to one specific asset class, industry, company, and something happens to impair that might be something that you can't recover from. So that, diversification, not, having all of your eggs in one basket can be a very big mistake that people make. And secondly, I would say is allowing, we have so much emotion tied to our money. So I would say another big mistake that we see happen is making very irrational, emotional decisions that can have very lasting impacts on our net wealth over time. And, you see this happen, whether it's, panic and, selling and not recovering from that. So I would really say having all your eggs in one basket or making very, very emotionally driven mistakes are the two.
In the investment world that you live in, maybe just color that in a little bit. What are the most common emotional mistakes that people make? You mentioned sort of panic selling. Are there others?
Yeah. So from an emotional standpoint, panic selling would be the biggest one. We all know we're supposed to buy low and sell high.
That's the idea.
That's the idea. Unfortunately, what happens from human psychology is the exact opposite of that. And markets, if it happened to be in a downturn and there's a global event and markets tank, we panic and sell into that fear. That's just how emotionally we are driven as humans, and it hasn't changed and it won't change. So that is just how we emotionally are driven. And on the flip side of that is also that fear of missing out. So we know we're supposed to buy low, but we see these trends sometimes happening, and we see a rapid rise in the increase of a value, and we want to get in on that. Again, you're buying extremely high, and that can be very, very risky as well.
Yeah. I want to highlight one really important thing on this mistakes front. Especially driven business owners have a natural propensity to chase gains. And in investing, that is, of course, something that is important. But this concept around preventing catastrophic mistakes, especially when it's rooted in your psychology or certain basic decisions that you did or didn't make around diversification, are very important. Some really basic math to highlight. If you make decisions and sell when you shouldn't, are not diversified enough, have all your eggs in one basket, and take, for example, a 50% loss, you now need to make 100% gain to get back to where you are. And I think that that's something that's a little bit overlooked in a world that chases the upside, is the importance of mitigating the downside.
Totally.
So just to reiterate again, if you take a 50% loss on anything, it could be your real estate, it could be the value of your business, it could be the value of your portfolio, you now need 100% gain to come back up. So just as important it is to chase upside, preventing massive downside is arguably even more important.
I want to ask if you have any practical advice or things you found useful for clients of yours or just people you talk to in this space about adding some distance between their emotions and their money. Is there anything that helps people just buffer, create a bit of an insulation barrier between them and these rash decisions that they make? How do you get people to just calm down and stay cool when they really need to?
So one of the best things you can do is have a plan in place. And that's where we work with clients on these financial plans. And that's part of, a lot of your work that you should be doing on your overall net wealth is. So if you have a plan in place and this is where I'm trying to get to, I have a diversified portfolio, I've have an income stream, I've set aside the cash that I need for immediate terms, you are not in a position that you have to react to a market event on the downside and say, I need to sell to afford this, that I'm, if you've planned appropriately, you revert back to that plan and say, yes, I'm still on course. Of course, there could be a short-term pullback here, but I don't feel like I need to have an emotional response to that. So I think that planning aspect can be, very, very helpful when you go through those emotional periods to stay on track.
One of the investment vehicles or asset classes that contractors, our listeners, seem to really gravitate towards in particular is real estate. And we're gonna have some other experts come on in this series and get a whole series of different perspectives on this. When we think about the idea of eggs, all your eggs in one basket, where does real estate fit into that? Is that a different basket? Is it just same basket but different spot for the egg? What's your commentary around real estate as a way of building wealth specifically for contractors? And the reason I ask is because almost all of them do it. When we look at our membership, it's sort of it's like peas and carrots. I make money in a blue collar business. I do cool real estate stuff with that money. It's very, very consistent. So what are your thoughts on that?
So for one, it makes a lot of sense, right? It's what we are naturally gravitate towards. What do we know? You're going to have the inside information because it's the people you're working with, the experiences that you have, and the knowledge that you do come across. So it makes sense from that perspective. However, when you take that back to the broader conversation we're having here, the work and the business of a contractor is going to be very closely linked to how real estate performs. They are, within generally the same industry. They're going to perform very similarly to a market event or to where we're at in the market cycle or to what interest rates are doing. So really, while it might be slightly diversified in terms of it's not having wealth directly in your business, it's going to be very highly correlated to your business, meaning it will respond very similarly to how your business will respond. So when we think about wanting to have not all of our eggs in one basket, that's not necessarily solving for that issue. We really want to look outside of real estate to further diversify our wealth.
Why are they so correlated? That probably seems like an obvious question. Maybe I'll try and answer this and you tell me if I'm going in the right direction. Is it because as the price of real estate goes up, homeowners are more affluent, homeowners spend more on their house and contractors provide that service? Like, is that the connection point between the two?
That would be the connection.
Okay, so that's why they generally follow the same graph. Not perfectly, and we've seen this. I mean, you look at how contractors did through COVID when rates were down and stimulus was happening and nobody could travel. I mean, we literally just call it the COVID boom now, and it's directly correlated with the price of real estate. So
and people having access to
totally
cheap capital.
So it's just something to be mindful of. It's good. We'll talk about this again in other episodes, but it's good because you get it and you're well set up to force appreciation on it. It's not so good. Don't kid yourself and say, "Oh, I'm super diversified because I own a plumbing company and 4 rental properties." You're not really. Yeah.
So on that note, this is a really important distinction that I think is worthwhile to unpack and talk about. So over the last 10, 15 minutes, we talked about the need to not have all of your eggs in one basket, meaning all of your capital and your assets are the value of your business. We said diversify outside of them. But now what we're talking about is even when you do diversify and you do invest outside of your own business, don't just be in real estate. So again, might be a bit of a simple question, diversification 101, but can you tell us a bit about the philosophy behind the approach to diversifying within the context of an investment portfolio outside of one's own business?
Yeah, so diversification is really an investment strategy to mitigate risk. That's truly, and it's sort of known as the number one rule of investing. It mitigates your risk, and as you talked about, it protects you to that downside. There's something that we refer to as concentration risk, and that would be sort of the opposite when we have all of our wealth or a good portion of our wealth all within assets that are going to move in the same direction based on a market event. And that's where you are at risk of one market event having a significant impact on your wealth that you can't recover from. So we want to get away from that concentration risk over time as we can. So there's really 5 key ways when you look at diversifying that portfolio outside of your business. So what we look at is diversification within asset classes. We look at industries. There's various industries that you can be in. There's geography. There's the style of company, and then the size of the company. So if we want to talk about each of those briefly, so asset class, of course, the very common example that people will look to is stocks and bonds. And overall, stocks and bonds are thought to have been negatively correlated. So if your stocks are going down, your bonds, should be positive or holding up, or at least significantly less down. So that's where you see, that example of different asset classes behaving differently in a market event. The next area is industry. When we talk about, real estate being one of those, of course, but there's, 11, industries broadly defined within markets. So that's everything from technology, people will know Apple, Microsoft, financials, Visa, JP Morgan. There's a lot of significant consumer discretionary, consumer staples. You then have, energy and materials. So there's various different industries, and they are going to all respond to different market events and different economies very, very differently. So that's a great way to achieve good diversification within your portfolio. When we look at size, of course, we talk about market capitalization. That's sort of the size of the business. And again, small cap and large cap will behave very differently. When you have the smaller businesses, it can be a little bit more volatile, but typically have higher return potential versus larger cap, more mature companies. So that's another way you can have that diversification. Geography is another. So we sort of think of it in three buckets. You have the US, you have developed markets, excluding the US, and then emerging markets. So those are three, additional ways. So you want to have access and exposure to different markets around the world and not just be centered in maybe your home country. And lastly, style. So we usually break that down between growth and value. So you're going to have your growthy businesses that, maybe aren't paying dividends. They maybe are more volatile, really, really great growth within them. And then your value businesses, which are more established, long-term businesses, likely paying dividends out to their shareholders, aren't experiencing the same level of growth, but they're stable, secure, long-term businesses. So those are really ways that you can achieve really great diversification in your portfolio to know that you have some of that downside protection in market events.
That's a really good explanation. Thanks for breaking down those five. And so, what we're talking about here is I find just so interesting because, you can come to the same mistake even if you do invest outside of your own business, but you do then still concentrate it in stuff that is so familiar to you, which I think a lot of people do, right? Like if we are in Canada, we're going to invest. If I do buy stocks, I'm going to maybe buy some Canadian real estate investment trusts. And if I'm going to get into some real estate some other asset classes, it's going to be owning apartment buildings in my same hometown, stuff like this, right? So it's cool. I just find it fascinating that we have these instruments and these tools in this modern day and age available at our disposal just through the right relationships or through the internet to be able to own such diversified companies so easily. So if I'm a contractor, in Canada, I can own pharmaceutical companies in the US very, very easily, for instance, and diversify myself in 25 different ways through different sectors, different company sizes, different geographies. It's a really cool and exciting thing and tool that we have available at our disposal.
Yeah. So, and being aware of those biases that we have, right? When you say if you're in Canada or the US, naturally your portfolio will be way over tilted to where you are. Again, if you're within one industry, naturally your portfolio. So it's being aware of those biases and the tilts that you just naturally will put in place and try to mitigate that. And as you said, the technology and the product innovation that we've seen over recent years with, the ability and securities that you can buy to achieve diversification and the ease of access to, have exposure to various countries and industries, all in, basketed securities has really come a long way. And you can do it very inexpensively now as well. So there's great opportunities there.
Yeah, 100%. And I'll just say, like, from a personal perspective, like I do feel a good feeling when, as much as like I love the organization that I run and my company, when I buy regularly, let's just say over the last month or two, like Canadian banks, like the majority of our businesses in the US. So Canadian banks, Canadian oil and gas companies, like I feel good. And it's exactly, we're hitting the nail on the head from a diversification perspective. Like I know that I'm putting less eggs all in that same basket. So this is really cool. All right. I want to ask you a really important question here, Darcie. We're talking about different asset class mixes. Like you talked about like certain fixed income, stocks, different kind of alternatives. Let's break down for people, and we can keep this pretty elementary here. Like what are the different kind of asset classes that are available to people when you look at a really well set up portfolio? What are the different things that it could include inside of it? So let's go through a bit of a run through on those, and we'll talk briefly about what each one of those are.
Okay, great. So I think high level, you want to think about it as four buckets for these asset classes. So the first one that you want to think about is your cash or cash equivalents. And that really is, your lowest risk bucket. It's generally a lower return because, of course, often these cash allocations or cash equivalents are going to be guaranteed, whether that be, guaranteed by, backed by government or a bank that you're holding your deposits with. So that's really your lowest risk cash. And you want to make sure, we typically say, having at least 1 year of expenses within that cash bucket. You don't want to be in a situation where you don't have access to the liquidity that you need and forced to sell something at an inopportune time. So that cash is an important allocation there. You want to make sure that you have some emergency reserve there that you have access to at all times. And again, interest rates will move. So what you're earning on that cash will change in different market environments. So that will also impact perhaps how much you want to have in cash and equivalents. But those are some of you think of deposits that you have at the bank. You think of treasuries, high interest securities, high interest savings accounts. In Canada, you have GICs, guaranteed investment certificates, in the US CDs. So those are some of the different options of cash and cash equivalents to make sure that you have low risk, ease of access liquidity to you.
So this is stuff that's fully liquid, like you could grab access to at any time.
At any time or in the short term, yes. Yeah.
Yeah. Okay. So that's one.
That's the one first bucket. The second would be your fixed income securities. So that's, traditionally what we think about as bonds. So you are lending your money out to somebody and they're going to pay you interest for having access to that capital. So again, you can have diversification within that fixed income bucket, but overall you're looking at, this would be, a higher return than cash because perhaps you're lending to a corporation or a government and perhaps a longer term. So you're earning perhaps more interest than just sitting in cash. However, they're typically thought to be less volatile than some other investments. So, again, diversification by industry, by corporation, you have credit risk there as well. So if I'm loaning you money, you're going to pay me interest. What a government's going to pay me in interest is likely going to be less than, a startup company, the amount of interest that they would have to pay me. So there's credit risk to think about there, but that's sort of another bucket, that fixed income securities.
Interesting. Okay, cool.
Okay.
From there?
So then we have stocks or equities. Those would, if you buy a stock or an equity, you're essentially owning shares in a business. You own a part of that business. So if the value of that business goes up or down, you are along for that ride. Your ownership of that company, the value of your ownership can go up and down, and you're also entitled to a portion if they pay dividends or distributions. Your portion of those dividends and distributions. So again, the time horizon on this, we always want to make sure if you're investing in equities, typically these trade publicly on exchanges, so they are liquid. You can buy and sell them, at any day the market's open. However, you never want to get put in that situation where you're forced to sell. So we typically say you want to have a 1-year time horizon when you're investing in equities. And again, all those ways we talked about how you can properly diversify those equities again is important to come into play there. Mm-hmm. And then the last bucket that I would talk about is alternatives. And that's a very broad bucket. But really when we talk about alternatives, it's any asset that falls outside of those 3 traditional asset classes we just talked about of cash, fixed income, and stocks. So that's going to be, you can have private assets. It would be maybe private real estate, private debt, private equity. Your business would be considered an alternative asset from that perspective. They behave differently than your traditional, publicly listed stocks and fixed income securities. It would also include things like hedge funds. It would include things like commodities, energy, gold, collectibles, art. So any of those asset classes that really have a different return stream than your more traditional publicly listed asset classes.
Right.
Yeah.
Yeah, gotcha. And so a simplified way to maybe look at this whole like stocks, bonds mix is with bonds, you basically kind of own debt. With equities, you own a part of that company.
You own a part of the equity in the business.
Part of the equity in the business. Yeah, exactly. Yeah. So that's good. Benji, does it make sense? Is there anything you want to clarify in that group?
You make the distinction broadly between like value stocks and growth stocks, and I thought we went by it quite quickly. Do you want to just maybe flush that out a little bit? We're going to go deeper on it in later episodes, but how are those two things looked at differently?
So a growth stock is traditionally an earlier stage business. They're experiencing very high levels of growth within their business. They're investing all of their cash flow and profits back into the company, and therefore likely not paying out dividends.
So it's riskier but higher investors. Ceiling.
I would say riskier, more volatile, but therefore greater return potential, long term. Then you have your value businesses, which are much longer, more established businesses, typically larger businesses. However, their growth profile has moderated. They're not seeing the same very, very high levels of growth. So they're typically then returning cash flows to their investors through the form of dividends.
More stable. What would be some like really recognizable names or businesses that might fit into those two categories loosely? Like, are there recognizable growth stocks that people would know and recognizable value stocks that people would know?
Yeah, and I'll pick the larger,
Sure.
growth stocks that are more mature growth stocks, but are still experiencing that very, very significant level of growth. So that's where you would see a lot of the businesses like Apple and Amazon and Netflix of the world that still see that really, really significant growth within their business, and they invest a lot of that cash back into their businesses to continue that growth. When you look at more value-based businesses that have been along for a long period of time, you're looking at more the Home Depots and Walmarts of the world that are more stable businesses, don't see that same type of growth, and are having still very, very positive cash flow, but they return a lot of that cash flow to their shareholders.
Perfect.
Yeah, something I just want to like really simplify here. all listeners basically understand what it's like to run a business. And at the end of the year, when you have profit, you could do literally just one of two things with it. You could either keep it in the company and use it to grow, like you're investing into marketing, you're buying, more commercial space, you're buying machines, you're hiring more employees, and you're basically just use that capital to grow, or you could push it out to you, the shareholder. You kind of like have two options. And that's really what we're talking about here. When you talk about owning a stock, it might sound like this complex black box of the stock market, but you literally just own a piece of a company, and you've got companies that are growing really quickly, and they're going to take the money that's made at the end of the year or the quarter or the month and just keep it in the company and use it to fuel growth, or they're going to push it out to their shareholders in the form of dividends, and then you as a shareholder would get that dividend. That's kind of, am I correct in saying that's kind of what's going on?
That's exactly right. And you as a shareholder, if they're experiencing 20, 30, 40% growth, you want them to hold on to that money and reinvest it, because you're seeing those fantastic returns. Whereas in a more moderate growth business, you're very happy to see maybe that 5% dividend paid out to you every year, because that's, great cash flow for you to have. And they may not be, they might be growing at 5%, but you'd like to see that cash flow. So that's the difference.
Yeah, no different than if you're growing your business really quickly, rather than you taking a whole bunch of money out of it, that money could actually do pretty productive stuff by you keeping it in your business and you hiring that office manager and you hiring that general manager. Like, you're going to get a return by doing that. So that's that makes a lot of sense. So tell me this, Darcie. Let's talk about what these portfolios look like, or what they should look like when done properly. Now, absolutely, everybody's case is different. Their lifestyle, their family structure, how old they are. Like, we're not talking in concrete terms. We're going to talk in very broad terms here. But I want to talk about two different types of individuals. I want to talk about the younger, hard driving, fast growing entrepreneur who's maybe 5, 7, 10 years into growing their contracting business.
But has a lot of runway left.
A lot of runway.
Yeah.
They're relatively young, huge runway left. The company keeps growing. What should their portfolio structure, very broadly speaking, look like, as opposed to somebody who's been running their business for 25 years, is quite stable in their kind of life structure and style, and maybe looking at a retirement, not tomorrow, but 5 years out, 7 years out. Let's kind of break down portfolio structures between those two types of entrepreneurs.
Yeah. So the main thing to hit on here is your risk tolerance, or the amount of risk that you can take on at your various life points. It changes as you age. And if you're a younger investor, you can take on more risk, because if you do have significant downturn, you have a lot of runway, as you say, to make that back up. If you're just entering into your retirement years, you can't afford to have a big downturn in your wealth, because you don't have the same earning potential. You don't have the same time on your side to make up that downturn. So that's why we typically like to decrease risk over time. So if you're looking at sort of a younger portfolio that can be more aggressive in nature, more growth tilted in nature, typically we'll see less reliance on cash and fixed income securities, more heavily rated towards those equities that have come with higher risk, but at the same time have higher long-term returns associated with that. So you might have a 100% portfolio of equities, and you may not need to incorporate any fixed income within there. At the same time, you can have a greater tilt towards growth stocks that, again, are more volatile, but can have a longer term return potential, because you're not relying on the income of those stocks. So you can have all growth stocks that perhaps don't pay that income out to their shareholders, because you're working, you have a strong income, and you have a lot of time on your side. So let's contrast that to someone in their retirement years, or just entering their retirement years. You certainly want to bring down the risk of your portfolio at that time. So that might be incorporating, higher cash levels, higher fixed income levels, really enhancing that diversification to protect to the downside, to ensure you don't have a significant downturn in your portfolio. And it might be incorporating more of those value, really, really large cap stocks into your portfolio that are paying solid return streams and solid income streams to you, that you can live off those return streams if perhaps you're in retirement and no longer making an active employment income on your own. So that's typically, again, very broad strokes, because your individual situation will be, very much a factor in how you position yourself. But those tends to be generally what we see in sort of younger investors versus approaching retirement.
And I guess it's your job as the advisor, the planner with them, to over the years and decades kind of you meet with them, you get to know how things are changing, how their thoughts are evolving, their plan for retirement is maybe becoming more defined. And I guess it's your job to slowly move them from that higher risk set of assets, that bundle, to a lower risk one that pays out more over time. Like that's what a really good advisor helps a client do, correct?
Absolutely. You need to, over time, as you go through those different phases in life, you need to see those portfolio shifts to adapt to where they're at in their lifestyle, the income that they need, the risk that they can afford to take on, what's happening in their family circumstances, what their financial resources in. So that's our job as a financial advisor, to work with clients to ensure that that investment portfolio is more suitable for them.
That's done on a pretty gradual basis, case by case, individual to individual, family to family.
Absolutely. Yeah.
Okay.
Yeah. And so just to be clear, so for someone who's younger and in a high income earning growth period of their career, you wouldn't be alarmed if they're fully in equities. They own some real estate. They own just like good quality, high growth companies. And because you talked about these different asset classes of alternatives and cash equivalents, if someone is younger, would you be alarmed if all they own is real estate and equities, or is that, call it okay?
I wouldn't say alarmed. I still like to see, for sure, diversification among equities, different industries, sizes, asset classes, geographies. Typically, you want to see some cash to make sure that there is good liquidity within the portfolio there. That particularly if a lot of your net wealth is in a private business, that's not going to be maybe a source of liquidity for you. So you want to make sure that you have the cash on hand. But outside of that, particularly we just went through a very, very low interest rate period, right? So people were not very happy earning 1% on fixed income securities. So in those situations, absolutely. Again, another thing is your personality, though. If you are going to be in 100% equities and there's a big market downturn and your natural reaction is going to be to sell, then that's not the right thing for you. But overall, as long as you're very, very well diversified, if you're in a high growth, you're young, you have time to make up, then having 100% equity portfolio would not be completely out of the norm.
Yeah. And let me ask you just one very specific question, because this is the case for a lot of homeowners across North America. Like if have had substantial lift in the equity, like the value of my home, and I have a relatively low mortgage now, would you consider that a cash equivalent or not? Like if I could take $1 million out of my house right now on a home equity line of credit, or I could mortgage it, say I don't have a mortgage, would you call that like a cash equivalent, or would you rather see like actual cash?
I wouldn't call that a cash equivalent, because your home is very illiquid asset. And while you can access, if you don't have a mortgage or very low and you're confident that the bank would give you that, you still, we have no control over where interest rates are going. That's, in the government's hand, the hands of the economy. So you don't want to be relying on that until it's actually cash in your hand, because there's things that come up and you want to know that liquidity is available if you need it.
Cool. Awesome. Very interesting. So what I'm reading for this is kind of, and Benji, I think you put this wall between like that younger, when we kind of planned out this conversation, like the younger growing business owner and that older entrepreneur is kind of more stable. The way I'm seeing this is you've got kind of a growth runway where you get a lot more aggressive, you take on more risk, you take on more volatility, but you grow for a decade, 2 decades, 3 decades, and then you've built that mountain. And at that point, then you level it out and coast and take a lot less risk and get set up to be able to then start to draw returns from it.
Yeah,
right?
then it's protecting that wealth that you've built and delivering that passive income stream from that wealth.
But you got to build it first.
So
keep listening to this podcast and join BTA. When do you think, I'm sure it's probably easy to answer this question by saying like as early as possible, but when do you think, for the type of listener that we have, an entrepreneur, they got a business, they probably got a home, super ambitious, like when at what size and stage must planning for retirement become something that's quite intentional?
So yeah, the easy answer there is the earlier the better, because you have that the time is on your side when it comes to investing, and the longer that you're invested, the greater exponential impact that you do see. But of course, let's be realistic. People have priorities in place in terms of is it home ownership? Is it wanting to put a lot of that money into your business? So it is going to be very unique and personal, that decision. Having said that, you want to take advantage of the various, the various tax efficient strategies that are available to us. So if there's ways that you can take advantage of tax protected accounts, those are great ways to start building wealth early. If you're disciplined about taking a portion of your income and investing in that, it doesn't need to be a lot, but the earlier that you can start, that you have that ability to take some money from the business to be investing is the best time to really be doing it.
I mean, I'm not a pro in this, but intuitively I think about as soon as you start to have some medium-sized chunks there at the end of the year where it's like, hey, my mortgage is paid for, my car is paid for, we went on a trip, like my life here is looked after, but there's still 30 grand here, 50K or $500,000 here, depending on the size of your business. I think it's really prudent to start to do, at the very least, some habit building around this.
It's discipline. The discipline of it and study, because otherwise, naturally, you could just spend more, go on more trips and spend more. But the discipline of it is saying, okay, I have X amount left over. I'm going to take, X percent of that and put it away for growth over the long term.
Are you a big proponent of automated like account transfers, like just sort of set it and forget it type stuff, where it pulls $1,500 a month and takes it from this account where you can spend out of it to this account where there's not even a card attached to it? Like, are mechanisms like that useful?
It's a great way to incorporate discipline. It takes the reliance out of you to remember to do that and to not be spending it. So it's really a fantastic way to build in that discipline over time. So it's called pay yourself first, right? And it makes sure that you put a priority on that.
One of the things that people have been really successful long-term talk about is this idea of lifestyle creep. And it's worth pointing out, it is so incredibly easy for your tastes to just grow with your income and leave very little left. You just go from a Honda Civic to a Toyota to a Lexus to a Porsche. You go from a thing like it's you need nicer dinners, you need nicer clothes. And I think that you obviously want to reward yourself, you work hard, but there is absolute value in being really cognizant of how that just naturally seems to float up. Yeah. And that's why I love these auto transfers. If you can just get it away from you so you actually can't even touch it, it requires no discipline. It's not that hard because it's not there for you to spend in the first place.
Yeah, exactly.
Yeah, we've got Brian Scudamore in studio later this week. I don't know what revenue 1-800 Got Junk does, but it does a lot. He rolled up. We rolled up in our 2 Ford F-150s to the cafe. It's not lifestyle creep.
So here is another question I have. When you there is a very popular movement these days, and I think that these platforms do an unbelievable job marketing themselves. Questrade is one of them. What are the others? There's all sorts. Wealthsimple. There's all sorts of apps. And there's a bit of an idea around sort of DIY investing. Can you make the case for it, against it? What are the inherent risks of sort of following something you saw on Reddit or a clip you saw on CNN and going and making sort of unilateral investment decisions based on all that stuff?
Yeah. So to start with, yes, the technology and access has come a long way, that it is easy. It's simply logging onto a website and you set up an account. It's inexpensive. A lot of these platforms trade for free or close to free. So access and costs are certainly great advantages, but there are, risks that come along with that to be aware of. So first of all is, the access that we have to information right now is just flowing everywhere and we're inundated every day. So this trend investing that we've seen really emerge over recent years.
What is that? Do you want to just define it for us?
So again, when you're talking about, social media and Reddit and these online platforms that are sort of identifying themes that are out there and that are expected in the future, and sort of a lot of individual investors get behind these trades, and, it causes a run up in certain areas of the market. So the caution there is, by the time you're getting this information and it's gone through social media, it is very widely available. And oftentimes you've often seen a very, very significant large run up in the price of those securities. And the risk when you purchase a security after it's seen a 20 or 50 or 100 or 200% run up is there is a long way down from there. So it becomes market timing. Yes, could you catch the last bit of that trend and do very, very well? of course, but you also have a very significant downside risk there. So we really, really caution, investors that are doing it on their own to be careful of that trend investing, because you can be investing and paying extremely unreasonable valuations for some of those assets. That inherently is very risky.
You're kind of saying that by the time you're hearing it, you're late already.
You're late already.
That's kind of humbling.
So guys, what is like abundantly clear to me from not just listening to Darcie, but being kind of in this world for quite a number of years now, is this: to actually understand what is going on inside of a company that you're buying is incredibly complex, right? Like, I can only imagine like the level of analysis and the types of analysts that you have around you to actually understand like what is the true value of a company that you're buying, or a bond, or any one of these alternatives. It is, I would say, completely unreasonable for you as a very busy business owner running a contracting company with a myriad of complexities, and you're dealing with your sales team and your production teams and customers and your office teams and all this kind of stuff, that you would be a true analyst and understand what is going on and be able to dig even 3 inches under the surface, as compared to just getting the stream of like media headlines coming in. So I think that some level of humility is important here to understand. Like, it seems it's
simpler
easy
than it is. Yeah.
Well, there's a famous quote by Warren Buffett. What does he say? Like, in
It's
investing
simple, but not
is
easy.
Exactly. Yeah. And so to be able to log into one of these platforms, like to go on Questrade and put, AAPL or whatever the ticker is and buy Apple is like we could do that right now in 15 seconds while we're recording if we wanted to. But it doesn't mean that I actually know what is going on at Apple and where that company is headed. So do not be fooled by how quick and easy this seems. It's actually extremely complex, not to even mention the like life planning and long-term guidance element to it. So I think that there's quite a downside of this media stream and how quick it has become to transact, because it's made it all the more deceiving. You're actually doing something very complex. You just happen to be doing it in 15 seconds. It doesn't mean that you know what you're doing.
And I think it's worth mentioning the way that social media works right now is they don't make cool YouTube videos or Instagram posts about the losers. They just quietly, like, that's not what's making the headlines. So it's actually a slightly tilted view on reality when you see meme stocks do this and crypto do this, and I'm not necessarily knocking those. Like, I wouldn't say never do that. I'm just making a comment on how reality is shaped by this modern thoughtosphere that we live in. You really are zoomed in on the upside, and you have very little concept of the downside.
Yeah, and look, you see it in 2021, but you see it in markets where everything is rising, and you're doing it yourself and everything. You think, I'm great at this. This is really easy, and then you have a very, very wide awakening when all of a sudden that party stops and things go the other direction. And that's where we very often get the phone calls of saying, like, please take this off my hands. I don't have the time or ability to do this on my own. So I think it's just being aware of those risks, and that there is going to be times where it does feel easy when markets and asset classes and risk assets are all floating upwards. But the market cycles are here to stay. There will be ups and downs of the markets, and so you have to be aware of that and the risks that come with it, and make that decision of what's the best way for you to manage that.
Yeah, 100%. And if you're an avid listener of Contractor Evolution, I think one thing that you must be pretty clear on by now is that we are really big fans of surrounding yourself with experts and understanding like what your genius zone is. Benji really, for example, understands our content marketing strategies at Breakthrough Academy and drives Contractor Evolution. It doesn't mean, Benji, that you change the spark plugs on your car or you're doing your own root canal.
Right.
So why would you be your own investment analyst, right? It's the same kind of thing. Like, we have a lot of really amazing experts, whether it's in digital marketing, on tax advisory, whatever, on the show. And that's, I think, what we're saying is, like, understand what your genius zone is, do it really, really well, and have other people do all of the other stuff that they're good at and can free up your time so that you could drive your genius zone. This whole conversation, I think, is just another one of those. Yeah. So, Darcie, just in closing, we've had a really great conversation about this. Let me just ask you kind of like one fun question to close. Like if you had a closing piece of advice or for guidance or guidance, think, if you ran a specific investment knowledge and financial planning course for successful entrepreneurs, before you kind of let them out for the remainder now of their investment journey, what would be kind of on that last day of class? What would you say to them? What parting piece of wisdom would you leave them with?
So this is not, overly exciting, but it really comes down to the fundamentals of investing, and that is just of compounding returns. And when you look at, so compounding returns mean if you invest $1,000 today, not only is that $1,000 going to return you in the future, but then the return on that return is invested and returning for you. So what that means is, time is your power there. The earlier that you can start, the better. But if you invest today and let that money grow for you over time, the power of compounding returns, it just means that it can multiply your wealth exponentially over time. So it's not exciting. It's discipline, and it's allowing time to work in your favor and do all the things that we talked about today in terms of diversification and limiting that downside for you. But that power of compounding returns to grow your wealth exponentially over time is really powerful. So it's important. Start early and be disciplined.
Amazing. That is a really, really powerful piece of advice. It's a really crucial concept to understand. Like it's not sexy. It's like you just kind of map it out in a spreadsheet, so to speak. It's pure math, but it is powerful. It's if I invest $100,000 today and have a 10% return next year, I'm not investing 100,000. I'm investing 110, and put that into a spreadsheet and calculate it out over 30 years, and you'll see what I mean. It is a very powerful concept. So thanks for mentioning that. That is really cool. So just in closing, Darcie, if people want to chat more about life planning, financial planning, different types of investment instruments, tell us where they can find you.
So I work at Canaccord Genuity Wealth Management. My firm within that is Crowe Private Wealth, and I'm just at croweprivatewealth.com. Again, my name's Darcie Crowe, and I lead the group there. And again, it's investment management. It's that bigger picture, financial planning, tax efficiency, making sure that you and your family are secure for the long term.
Amazing. Good stuff. And we will link your website and your contact information in the show notes right here. So if you're watching on video, click right below the video. And if you're cruising in the truck and you're listening on the podcast, just click right below in the podcast notes and we'll link that in there. So Darcie, thank you so much for joining us on Contract Revolution. It's been an awesome chat.
Thanks for having me. It was fantastic.
Thanks for coming. Thanks so much for watching this episode of Contractor Evolution. If you've already subscribed to our channel, consider sharing this episode with another contractor who you think needs to hear it.